markets in perspective, especially what's happening in Turkey and the ramifications of that economy going into a bit of a tizzy. Russell Napier, a noted financial historian as well as independent investment and strategist, co-founder of ERI, joins in with his views on the same. Russell, it's great to have you. Thanks very much for taking out the time and joining us from UK. You know, you've been calling for a big risk in Turkey. It's not just in your recent note last week, but I think for as long as I can remember, over the last 2 years since the coup in Turkey, you've been talking about how there's a big default risk, which is a big overhang for the region. How bad can the situation get?
The currency has moved so much and interest rates have moved so much that the answer to that must be yes. Unlike India, Turkey has borrowed a huge amount of money in foreign currency. In fact, the foreign currency borrowings of Turkey are getting close, certainly above 50% of GDP, almost certainly above 75% of GDP and close to 100% of GDP. And you may say, how can I be that inaccurate? Well, I know exactly how much the foreign currency debt is. It's $438 billion US. It's just that the exchange rate moves so quickly, it's hard to assess the size of the Turkish economy in dollar terms. But these are numbers from which it is very, very rare indeed for there not to be a default. Now, the double problem for Turkey is that 3-month money, 3-month interbank rates are 22%. And I'm sure everybody listening to this will realize just how punitive interest at that level is. That's the interbank rate, so anybody going to a bank will have to pay a premium. I think at the minute a significant premium to that rate. So yes, default. And the important thing for investors, global investors, is that the total amount of debt that Turkey owes to the foreigners in both foreign currency and lira is $467 billion US. So that's a big number, and to put it into context, Lehman Brothers had $618 billion worth of liabilities on its bankruptcy, and Turkey on credit alone, and there are other exposures people have to Turkey, but on credit alone, it's $467 billion. The global financial system is exposed to, compared to Lehman's is 618. So it's a big number, and it's important for global investors.
Right. I know that's a big number, but is there a clear and present danger, and that's what everybody's debating, of a big default on foreign debt in Turkey?
By the government. So the interesting thing about this debt is, of that 467 billion, the foreigners have only lent 95 billion to the Turkish government. The vast majority of this money has been lent to Turkish corporations, and a big chunk of it to Turkish banks. So we're not talking about the government necessarily defaulting, and certainly the government would not default on its domestic lira-denominated debt. Countries that own the printing press very rarely do that. It does happen. Happened in Russia in 1998, but it's quite rare. Now, what we're talking about default on is the foreign currency debt owed by corporations and banks of Turkey, and that is highly likely. I mean, the restructuring of domestic currency debt has been underway since last November by some of Turkey's biggest corporations. So restructuring, default, call it what you will, but it began last November. It's been underway for some time, even before the currency collapse and even before interest rates got to these astronomical levels.
So Russell, morning firstly, but what would be the ramifications of this financial crisis in Turkey? The finance minister in Turkey has already addressed concerns. Qatar has infused liquidity to aid the economy. How much of all of this can really help resurrect the situation?
Sure. So, yeah, that's really an interesting point on that money coming from Qatar. And actually, for several years now, Turkey has been able to access capital, not really from the pure private sector, but we might call that Qatari money public sector money. It's controlled de facto by the government of Qatar, and Turkey has come a long way, or got a long way into this mess by relying on that money. But it's worth pointing out that this is a trap that is sprung, this high foreign currency debt. It's very hard to get out of it. And one thing that might happen as $15 billion worth of Qatari money comes in is that $15 billion of Turkish private sector money may well go out. And I am surprised that the Qataris are prepared to put that money in without some sort of move to capital controls or restrictions on capital outflows. And just to stress, I believe that's what will happen. So there are two ways in which Turkey can default. The normal way, which is its corporations are simply unable to meet their obligations to foreign banks, or secondly, that capital controls make it illegal for those to meet those obligations. So the implications fall very squarely on the European banking system and emerging markets. But I think that we're not focusing enough on the impacts of Europe of this. The banks that are really heavily involved in this are all European banks. There's also a large level of bond investment, which is different this time. That wasn't an issue in 97 in Asia. It wasn't an issue in 82 in Mexico. So we're going to have bond investors caught up in this, and I think a significant amount of those bonds are also held in Europe. And then the unthinkable, unknowable and unthinkable issue for Europe is what happens if one of the things that the president of Turkey decided to do would be to release the refugees, the 3.5 million refugees that he currently looks after with payment from the European Union. We can't know if that's part of what's going to happen, but it's clearly a bargaining chip, which he keeps alluding to, so it's not impossible that would happen. And for the unity of the European Union, I think a large influx of immigrations at this stage would be important. So it's negative for Europe. It sends the dollar much higher because the American banks really are not exposed to this at all. And that's very positive for the dollar, and I think we all know that a strong dollar is not good for emerging markets. And then just finally, the implication for emerging markets. Capital controls in particular would be dire for emerging markets. The world's capital would then be worrying where else this was going to happen. And they would see strong men as a risk. And the strong men that one could obviously point to would be in the Philippines, in China, Romania, Hungary, Poland, and Mexico. And in terms of India, obviously the Prime Minister Modi is in a very strong position. But he has, over the last few years, built up incredible credentials as a man prepared to work with foreign capital. I don't really see any risk that suddenly that foreign capital would see him as a Erdogan-like risk. I think that's really very, very unlikely. But in those other countries that I mentioned, there are strong men already overruling the rule of law and taking actions which will increasingly make investors nervous. So all of this is very bullish for the dollar, negative for European equities, and I think also negative for selected emerging markets.
So taking the last point forward, Russell, do you think that contagion fears are real, or would you say they're overdone? I mean, can this impact emerging markets in a meaningful manner?
No, it definitely spreads from Turkey. Now, Turkey's fundamentals are by far and away the worst out there. I mean, there's no doubt that Turkey has done some very silly things that other emerging markets haven't. And I think people listening may say, well, isn't it unjust that emerging markets would be penalized because one of them has misbehaved? But remember, what we're really talking about here is a strong dollar. So the ancillary impact of Turkey is a strong dollar. And a strong dollar is never good for emerging market equities. People tend to follow the dollar for reasons that we all know, and that tends to tighten monetary policy as the dollar goes up, number one. Number two, and it is very unfortunate, but emerging markets are grouped together. A lot of emerging market exposure is held in open-ended funds, and if people begin to pull money from those funds, well, they simply will find it incredibly difficult to liquidate the Turkish bit of the portfolio to meet those redemptions. That part of the portfolio was already quite illiquid, given what's happening in Turkey, could become entirely illiquid if capital controls were implemented, and therefore in the move away from emerging markets or the Turkey instigates a move away from emerging markets in general. This was exactly what happened in 1997. It was exactly happened in 1982, and to some extent, as I say, it's very unfair because it has always been unfair to call them emerging markets and group them together. I mean, the comparison between India and Turkey, well, there really isn't any comparison between India and Turkey. But unfortunately, in the world of international capital flows, a business which is not always the world's most rational, then there is spillover. There's also lower commodity prices, which we saw fairly dramatically yesterday. That's a positive for India, not a negative, but there are some emerging markets for which those lower commodity prices are very negative. So we'll all focus on the direct impact of Turkey. But the indirect one, rising dollar, falling commodity prices, actually that's why we find ourselves with negatives for emerging markets. We should have one final thing on that. There is one emerging market which has never devalued in the last 20 years, not in any significant way, but it is now devaluing, and that is China. So when we look back on Turkey, and this period of history, I should say, although Turkey is grabbing all the headlines today, what may ultimately be the most important thing is that China does seem to be moving to a much, much more flexible exchange rate. And as we discovered in '94, when China did its last major devaluation, that has punitive impacts on anybody who's competing with China. And I believe that the Chinese devaluation would be the worst part of all these ancillary issues. That would be the worst one for emerging markets.
Russell, then very directly, because you touched upon India, where does India stand amidst the news flow that risks emerging market inflows or investments? The rupee has gone past 70. Indian macros are being tested too, especially with what's happening on oil prices, with policy making back home, especially when we are also going to be talking elections very soon. So that's a backdrop in which you need to kind of evaluate, the macro headwinds. Can India hold its own if the broader EM trade is turning negative?
Yeah, so I don't think it can, but this is not terribly bad news for Indian equities and Indian market. But I don't think it can hold up, and it isn't holding up. I note today that in dollar terms, the MSCI India dollar index is very close, not back to, but almost back where it was in 2015 in dollar terms. It hasn't really made much progress over that period. Obviously, a big dip into 1Q 2016, a huge rally, but now not too far away, and it's been kind of trading like the other emerging markets. So, as I said before, it's bad. It seems unacceptable that it should trade like other emerging markets when it's so different, but it does definitely get caught up in this. So, over the many years that we've spoken, Tanvir, we have. I've discussed my optimism for the Indian economy, which has never been matched by my optimism for the Indian equity market, because it appears to be so expensive. So once again, we shouldn't confuse the two things. The Indian economy may have some issues with what's going on in emerging markets. It will certainly have some issues if China devalues. But it seems to me that of all the emerging markets, it remains, from an economic perspective, one of the most flexible. But remember, the first kind of rule of basic financial history, over the long run, there is no relationship between economic growth and the return from equities. As Mr. Buffett says, price is what you pay, value is what you get, and at various times in history, equities can be so expensive that it can take many, 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 many years for the economic growth to have a positive impact. So I don't think the Indian economy will find itself as troubled as most emerging market economies, but I still find myself in a situation believing that the equity market is too expensive and is reflecting a lot of good news at a time when the world, not just India, but the world is facing more bad news in Europe and in emerging markets.
Right. Then finally, Russell, the weakness in the rupee is being seen as a positive for Indian exports. But if I go by what you're saying, simultaneously, if the yuan weakens, doesn't then that increase the prospects of higher exports from China? Doesn't it put China in a more advantageous position versus other emerging markets? So this whole trade of all expectation of trade bias coming in, export competitiveness, that theme would get diluted.
Yeah, very, very much. I mean, that is the crucial difference this time, is the yuan is part of this devaluation story, which it was not in 1997. It stayed very steady against the dollar then. Now, it's the second biggest economy in the world. It's one of the world's biggest exporters. This really, really, really matters. Not just that, the stability of the yuan relative to the dollar has forced over many years the Chinese to print too many yuan, have very high levels of nominal GDP growth, and also forced them to hold far too many treasuries. So we're looking at the change of really what has underpinned the global monetary system and global growth for 2 decades. That is changing, and that is really what makes me nervous. I mean, obviously, when something changes that hasn't changed in 20 years, and between the world's biggest economy and the world's second biggest economy, it's big news. It does make it very difficult to predict when you get this structural shift just what it does mean. But I think for emerging markets, when the RMB goes down, that is fundamentally bad news, not good news. They have a lot of dollar debt. India is not one of those, but there are others with dollar debt. And really, we're reaching an incredibly important point in world history here. Because historically, if you're an emerging market and you followed the dollar, you were following the renminbi de facto because the two were linked. So you really didn't have to worry about that. Now, if China is moving to the flexible exchange rate, which it appears to be doing, every emerging market has got this huge question to answer. Do I link my currency to the world's biggest economy, a protectionist economy, an American first economy, or do I link it to the Chinese economy where, and this is really important, if China is about to reflate, as it seems to be trying to do, that is a country that will move to current account deficit. That is the country that you might want to be linked to. If you believe there's a current account deficit coming in China and you want to sell things, you want to be linked to China and not the US dollar. But in the intervening period, we're talking about emerging market currencies falling against the dollar. That has always been problematical because of legacy US dollar debt issues. But this is one of the seminal moments in world history. Everybody who runs an emerging market is going to have to answer that big question. Do I follow the dollar or do I follow the renminbi?
Russell, such a pleasure having you on the show today. Thanks much for taking time out and speaking with us on ET Now. It's really great to get your vision on where you feel the entire Turkey economic crisis could actually lead to and whether or not there is a contagion effect or fear really emerging out of that.